Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Ian, welcome again today.
Hi Don, how are you?
Very well, thank you.
Excellent.
Making money in stressed capital markets is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Luckily, Ian is here today with his latest press release from Siberia Capital. Ian, you mentioned the World Cup is over, but the war with Iran isn't, and there are more liquidity problems incoming.
Yeah, so I think markets were assuming that punch up with Iran was, if not over, but controllable. That doesn't seem to be the case. I'm hearing lots of examples where people you wouldn't think to be in financial trouble are in financial trouble because of the Iran conflict. Oil traders who are long of oil but can't sell it and can't get it either, which is kind of crazy. So they're having to cover their shortfall by selling gold and other whatever else they've got. So in that example, it was they were long oil in Oman, and obviously no one was going to take any oil out of Oman, and they were short of Brent, which is off the coast of England, which obviously went up 50%. So big margin call on what they thought was a hedge position, so I had to sell gold. That's just something I heard on YouTube earlier, but absolutely rings true on the liquidity crunch we've seen since the Iran war. All risk assets are sharply lower. Not helped by the IPO sucking money out of retail investors, and not helped obviously by central banks thinking they're going to hike rates because of inflation or perceived inflation, and running economies in a way that liquidity is not positive.
You mentioned about the US money supply increasing by $3 trillion over the last 3 years. So if money supply is rising, but the market is starved of liquidity, what's driving the disconnect?
Firstly, money supply isn't liquidity. Money supply is, the M2 measure is notes in circulation and deposits of up to $100,000. Term deposits are easily breakable. So it's free money available to people, but although a lot of it has been created, that doesn't necessarily end up in liquidity for capital markets. When the Fed prints money, actually it goes to bank reserves, so it buys bonds off banks and it says here's some reserve, you can lend against that if you want. So if the banks don't want to lend, then the central bank or the Fed can do as much QE as it likes. No one's going to get any money.
No.
That is separate from our conversation, just shows you that there are different processes in place. Also, lots of money getting sucked out of the US economy because it is the reserve currency, as usual. That's the whole purpose of it. But now it's going to paying interest on debt to foreign entities, for example, so it's not even going to anything useful. So although the money is being created, it's disappearing into deficits and other places, and it's not there as readily usable liquidity for capital markets when needed.
You mentioned about the risk assets, so gold, for example, falling. Is this signaling a genuine macro slowdown or just a position unwinding after an overheated market?
No, I think it's actually margin calls. So if you need liquidity and you don't have any, then you've got to sell something. And certainly, as we saw when the war started, lots of central banks and countries were selling their gold reserves, to support their currency. So they're selling it for dollars, selling dollars to support their currency, or they're selling it to bankroll buying more oil at a higher price. And in any case, even if that doesn't take up all of the gold you've sold, they need the liquidity in case of emergency.
You also touch on in your release about other assets, die-hard US tech stocks under pressure.
Yep.
IBM losing 25% of market cap and 20-30 drawdowns in semiconductors. Is this a healthy rotation within the tech industry or a warning sign for the AI group?
I think it's a bit of both. So there is definite rotation, as we've seen profit taking in chip stocks. We'll talk about IBM when we go into the charts. But certainly there has been some rotation. Is that a warning sign for AI? Probably has prompted some of that rotation. It's gone into bellwethers like Apple rather than leaking out into gold, Bitcoin, etc. So the money is staying where it is, it's just being rotated, which is good. Of course, there comes a point where it's not being rotated and everything has to get sold. I'm not saying that's going to happen, but at the moment it is good in that it's rotating.
And with the liquidity conditions, will the Fed come to the rescue? And again, I'll probably get you to expand more from your press release on that.
Yeah, I mean, I don't know the answer to that question. I think we're all waiting to see Mr. Walsh on the 29th in the next FOMC meeting. He started off what the market perceived to be hawkish. I don't think he really was. He's just trying to make the entity as credible as he possibly can. One of the key roles at the Fed is to be the lender of the last resort. So if they're going to have to bail out financial markets, US financial markets at least, then they're going to have to do it. But if we remember all the criticism they took after the GFC, when they didn't need to bail out Lehman Brothers because Barclays Bank, an English bank, was going to do it, but the UK government said no. And then the US government said they weren't going to be the lenders of the last resort. So which put on a whole wave of QE and other programs that they made up on the spot to save banks. But in reality, they weren't the lender of last resort. And with the numbers that are flying around now, trillions, there's no way they can be the lender of the last resort in a smash up. So is Mr. Walsh going to start positioning it such that we start to think of different ways about the monetary policy? Well, he mentioned money supply the other day in his speech to Congress. This is money supply that we mentioned earlier, has been kind of hidden from Fed thinking for decades because it's inconvenient and embarrassing if you suddenly create $3 trillion in 3 years. But it is rather key to monetary policy how much money you have in the system. Anyway, the point being, he's obviously going back to basics and the true economics of it, rather than what the Fed has been criticised for in recent years is meddling in things that don't concern them, building refurbishments, all sorts of political gestures and stuff like that. So he's going back to basics. What is monetary policy? Let's revisit money supply. We're waiting for him to tell us something, because he didn't tell us anything apart from the fact that what the task force is last time.
So we've got another week or so to wait for that, for the 29th.
Yeah, Wednesday week.
Yep, exactly. Is there anything else out of that press release you wanted to cover as well? Markets
are nervous, but with what I'm perceiving to be as an increase in hostilities with Iran, I don't know if that's the right way to phrase it, but markets haven't fallen out of bed that I expected them to this morning. So, and the dollar isn't even higher now. It was a little bit to start with. So we're looking to find a bottom in markets, but Iran may not allow us to do that.
Let's have a look at those charts then, especially some of those tech stocks and the impact of the money supply.
So this is what we were talking about, IBM. The end of last week, their stock dropped 25% in a day. You can see it started there and kept going down. So massive liquidity, massive volume, so real selling. So they switched in their quarterly announcement, they switched their spending, it would seem, from spending on AI to hardware. And the market took that as a very bad sign. i.e. they don't have enough hardware to run their AI programs, and they're no longer investing in the future. Okay, it was one earnings, but it was enough to prompt a lot of people to get out. We're seeing a similar but different thing in SpaceX. So, it's only been going for 2 weeks or so, 3 weeks, but it's already, it looks horrible, right? It's already below the initial opening price when it listed. It's already 40% below the high, and very soon all of the insiders are going to be able to sell their shares that so far they're not allowed to. There's many things where all of this money's been sucked up and is now losing money, and something needs to happen. So we've seen Apple put on $1 trillion in market cap in the last, let's call it 3 weeks for the sake of argument. So it's had a nice run from 270 odd up to 333 in 2 weeks on other tech stocks going down. So even though there's all of this stuff going on, we don't have a clear view from the indexes anyway, because this is the S&P 500, where it was in a wedge pattern and broke higher, but we're coming right back again. So we're kind of where we were before we broke out. The NASDAQ is showing equal signs of not being able to make a new high. That high, the all-time high, was 1st of June. We haven't got back up there, and now we're sort of beginning to move down. Some rotation into the Dow Jones is inevitable. That's had a pretty good time since 27th of March. So that's done really well recently. But you can say the stock markets are, I wouldn't say topping, but they're looking toppy, i.e. they could top, but we have no confirmation that they're going to, and lots of individual stocks going up and down in huge volume. So if SpaceX is a $2 trillion stock and it goes down a lot, that's a lot of capital wiped out. So all of these indexes are really owned by the big $1 trillion companies now, so susceptible to big price moves. If we go and have a look at gold, gold has been going down in this channel between these two wedge lines, so it's just been going down all year, but is trying to form a bottom here. So that's a double bottom at the moment there. Whether the liquidity situation will allow it to do it. Silver, similar sort of thing, but not looking very happy. Brent oil, as you can see, since the 2nd of July has been going up, and we're getting to the point where we really broke down earlier, which is around 93 on spot Brent. So oil has gone up, dollar has gone up, risk assets trying not to go down, I think would be the best way to describe it. Equally, Bitcoin trying to form a head and shoulders bullish formation, where this should go up by the distance between the head and the neckline, so up here somewhere, but it's really just going sideways, so not very convincing there. Ethereum, a lot of talk around tokenization of real world assets. This is the one we've been buying recently, looking a bit better. These two support lines are really support lines going back to the birth of Ethereum. You'll see the dinosaur appear in a minute if we go right. There he is, there's the dinosaur. That means there's no more data because the coin didn't exist. So it's trying to hold on, because if it breaks a lot below these support lines, it's kind of going to zero in a joking way, but it won't be looking very good. But it is doing better than most things. The dollar is higher, but is trending lower within that. So it can't make these big moves anymore, it would seem. Even dollar yen strength is slowing down. The one to buy when you think that dollar's going lower is Aussie, because here's a good support line since March or April, and we've had two good goes at support. And now we've just been banging along it, and here's your 200-day moving average, and here we're now moving above support, so up into towards 70 cents. So there's a good opportunity for it to go towards 72.50-ish in the near future. If your view is that the dollar is weak or possibly just going to stay where it is. Yields are kind of higher but not doing anything. So this is the Japanese 10-year. So that's, excuse all the lines on here, but over the last few years it's gone from 0 to 2.7. Hasn't saved the yen because capital is leaving the country because of higher yields abroad. That's pretty much it for now because we've already done the stock markets. Anything else you wanted to ask about the charts?
Not in relation to the charts. In relation to other things coming up is probably next.
Yes, so this week we have holiday in Japan today. UK CPI, that will be weak. We've got the ECB interest rate decision. So they hiked 2 meetings ago in front of what was elevated prices paid, CPI. I suspect they'll wait and see what happens, as will the Fed on Wednesday week. And we're really waiting, as I said a couple of weeks ago. Markets are wanting to go on holidays, and the Middle East won't leave them alone. They've seen the World Cup, they just want to go to the Hamptons for a few weeks. A few other headlines. Chinese leaders talking the further deterioration of the Chinese economy, 4.3% GDP. Market thinks they're fudging the numbers massively, so even a 4.3, which everyone would be glad of, we think they're just lying about it. And it's a lot lower than previous, so obviously it's slowing still. 4 years of price decline in houses are just eviscerating households. Lots of instability amongst the leadership in China now, and biggest indebted nation in the world. Much bigger than Japan. As ever with China, we'll never really know what the numbers are, but it's huge because they report the federal government, if that's the right expression for China. It puts all the debt into the local municipalities and stashes it there because they can churn them and burn them and refinance them, and because all the banks are Chinese. So not really sure there, but it's going bad. Lots more IPOs coming in terms of energy plays, so that's more money drained from the markets. So really the theme is that lack of liquidity real? Iran war doesn't have to go on for too long before we'll really find out about that, unless someone does that. But kind of central banks need a way to reposition themselves away from the current story of oil price go up equals inflation, which isn't necessarily true, but they think it is.
All very interesting. Wonderful. Quite a lot of things to keep in mind and take on, so I really appreciate the insights for this week.
Thank you.
That's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website, or alternatively, you can subscribe by accessing the link at siberia.capital/contact. Thanks, Ian, again for this week, and look forward to next week's podcast.
Indeed. Thanks, Don. See you next week.
Thank you.